All right, everyone. So it's 6:02, and in the interest of time and for everyone who's here already, let me kick off the operator's studio by Let's Venture. And we're happy to have this partnered by Oracle NetSuite. Just to give you all a context to what the Operator Studio is about, this is essentially a monthly webinar that we run where we pick up issues and topics that are core to running businesses. And we try to keep the conversation as operational in that sense as we can. So the last time around, we actually spoke to folks in the AI ML space about managing system architecture, right? And we had CTOs of two really good startups in that space come and talk about actually building out the challenges that they face there and some of the processes that they've been able to, I don't like to use the word hack, but they've been able to figure out. And today we are talking about managing scale or scaling up by streamlining and better managing your operations and finances. And to do that, we actually have a two-part webinar today. So in the first part, we're talking to Rahul Puri, who heads up the global equity practice at Oracle NetSuite. And in the second half of the webinar, we'll be joined by Ashish Papadia, who's the CFO at Bloom Ventures, Rhythm Arora, who's the CTO and manages operations at Cubix Technologies, and Harshit Goel, who heads up finance and compliance at Atlin. So all of our speakers are here, and I think we have a good quorum going in terms of all of you folks who are attending. So let's get this started. Just some basic housekeeping. We'll try and keep the entire hour and a half that we have as engaging as possible. So I will ask you guys to keep queuing in your questions on the chat window, and I'll try and keep incorporating those as we go along. At the end of each session, we also keep 10-15 minutes for just an open conversation. But if you'll start putting in your questions here, I'll try and make sure that we have everything addressed in the conversation itself. And we also steer the conversation in the direction that you guys want, because this webinar is for you, right? So let's get started. Let me begin by introducing Rahul. So Rahul's been dubbed as Mr. Private Equity by a lot of magazines in the US. And I think he's earned himself that title because he's been a career, he's spent a large part of his career at large private equity funds and venture capital funds. And now he heads up the private equity practice for Oracle NetSuite. Oracle NetSuite is an ERP systems product that a lot of large organizations, large and small organizations use to bring in more efficiency into their operations and finances. So Rahul, thanks very much for joining us today. And let me actually just kick off and ask you to tell us a little bit about yourself, what you see as the high points of your career, and just this particular stint with Oracle NetSuite. What keeps you busy nowadays?
No, thanks for having me. And hi, everyone. As Sana mentioned, a couple of things I'd like to mention. Obviously, I'm out of the New York area, so it's a bit of it's not that, it's kind of 8:30 in the morning, so not that bad. But two things. One, I'm at NetSuite. I run what we call as our global private equity and venture capital practice. I've been here now 7 years, and the whole focus when I joined was to build a focus around working with both private equity and venture capital firms. We understand that, you know, VC-backed, private equity-backed companies are unique in the whole investment thesis, growth, etc. So our team is a global team. Obviously, is set up to work exclusively with these high-growth companies, whether it can be early-stage companies, which are obviously very relevant to our conversation today. Could be very large companies as well, could be in the hundreds and billions of dollars of revenue and pre-revenue as well. So that's the kind of gamut we play in. And I've been very fortunate. Dosana, I know you mentioned that I have worked with PE/VCs. I actually have not, but I've just been very fortunate and kind of working with a lot of private equity and venture capital firms globally to help think about some of the technology value creation. Before ADP, before NetSuite, I was with ADP, kind of corporate strategy, corporate development. And then part of that was more kind of Big Four consulting with Deloitte PwC. So that's a bit of the background. Highlights wise, it's great to work with companies early stage to see them kind of growth. I mean, last year I was working with a company probably a year and a half ago, and they were pre-revenue, and they just raised their Series A last year or early this year. So just seeing that growth and partnering with them is definitely a big highlight for me.
All right, Rahul. Let's talk about, before we begin by talking about the challenges that startups face, I actually want to ask you what you've seen as some of the challenges that the VC industry today is facing. Any of this that might have gotten worse off because of COVID-19? What are some of the changes that you see or the rumblings that you see happening in that space?
I mean, that's a good question, and I'll give you a share. I'm trying to get some data, and I'll share some data as well as some anecdotal stuff based on especially the last 6 months. I've talked to quite a few number of VC funds itself, and obviously the rest of the panelists later on will be, take it from a bit of a different view since they are sitting at those firms or those companies. Obviously, as an industry, VC is a tough market. When going in that you're going to invest in, let's say, 10 companies and 6 or 7 of them are not going to do well, that inherently is a tough market. Right? And then you start putting in kind of the COVID-19 and other stuff. So, at the outset, there's the data piece that you kind of think about, right? And it's interesting. So many early stage VCs we all anticipating, hey, there'll be a drop in some of the pre-money valuation. And as per data that I saw, hasn't really happened. And what I mean by that is because the impact of the pandemic has only been there for 6 months. And the median time between early stage rounds is about a year and a half. So I don't think we've seen a lot because also a lot of the companies haven't returned for capital infusion. So, I mean, that's obviously, this is up to, I think I was looking at data in PitchBook, which is up to June 30th. So at least the first 4 or 5 months into the pandemic, haven't seen that. And same thing with even some of the kind of late stage VC valuations, right? And we all feared that, hey, with the lockdown and economic turmoil, in fact, at least in the US side, the late stage companies have seen a big growth. And I think that's more because a lot of the mega deals are still happening in the second quarter, at least in the US, right? But so if that's on the data piece that you kind of think about, but I think as the months and years progress, we'll obviously see a lot what's happened. But based on a lot of the conversations I've had, it's critical if you think about it from a VC perspective. There's raising funds, deal flow, valuation. Right? You kind of think of those big three. There's definitely a lot of drop in the business activity, right? And for that, I was talking to a VC firm, very large VC firm in the US, and they obviously are cross-border in Europe and India as well. And they said, well, if I have to go invest $10, $20 million in a company at whatever stage, I'm not going to just do it on a Zoom call. I have to go meet the person, see his or her body language. So, I mean, those basic stuff that we always took for granted, I think are multiplied by X during the current times. And same thing with from a valuation perspective, right? And obviously there are some industries that are doing really well. Think about what
productivity and all of those, right?
I mean, if you think about even the whole telemedicine space, right?
Right. Education, yeah.
What we've done in the last probably 6 months, I don't think the world has seen the last even 10 years, right?
Yes.
There are these growth areas that are happening amazingly well. And of course, there's supply chain constraints, retail's hurt badly. So depending on where a lot of the investments are, I think it's been interesting. But I always feel, after every downturn, there's something big happening. You think about PayPal coming out of the .com. We think about Airbnb and Square and Stripe. They're coming out of the financial buzz. So there's going to be big companies coming out of this downturn, I think, as well.
All right. The other thing that we've been noticing, at least in the Valley, is that a huge emergence of a lot of micro funds, right? I mean, even in the last couple of weeks, I think I saw a couple of announcements of new funds being launched. What do you make of that trend? And we're seeing some of that in India as well, albeit not at the level at which activity is taking off in the Valley. But what is a lot of these smaller micro funds, the emergence of these funds, sector-specific, domain-specific funds mean for the ecosystem?
Yeah, I mean, that's interesting because you kind of think maybe not in the last 1 year, but even you look at the last kind of 3 to 4 years, right? and maybe 5 years, I've seen mega funds like a KKR go and raise a $700 million growth fund. And they're like, hey, valuations are high. If I'm going to go invest in a company later in stage, I'm going to pay so much X over that. So why don't I get in a bit early? And it's not even the mega funds. I think everybody's kind of moved down a spot, for lack of a better word. And there are companies in the growth equity have gone into late stage have gone to early stage, and kind of, so that shift has definitely happened, right?
Right.
And I think also in the last 10 years, there's so much of capital that's been built in, and there are a lot of people who made a lot of money from exits, and they've said, hey, why don't I go with my expertise, to your point, Saina, is, I have this company, I sold it for $1 billion or $500 million. I did extra money. I'm going to go put and invest in smaller companies to see that growth perspective. So that has definitely been a big play. I mean, even from a data perspective, in the last 1 year, I think there have been 70 funds, new funds being created in the US with 10 million or less. And I was looking at some data in India. There have been, I think, in the last 12, 18 months, there have been 20 funds in the same range, right?
Right.
I think that surge is going to happen a lot more as things like you mentioned, telemedicine or education, and people who obviously done well in those spaces in the past have said, hey, I have a little bit of money. I'm going to start my little fund here. And it doesn't have to be a large fund, right? I'm going to invest in 2 or 3 companies and then try to ride the wave there. So if you've seen in India 16 new funds being created just in that kind of not small cap, but early stage, I think that should double more than the next year or so.
Right.
And we track that fairly closely also because, a lot of our focus is in Asia as well, in India and Australia, etc. So that becomes very important for us to kind of look at as well.
All right. A lot more choice for founders, for sure, right? And that can't be a bad thing.
Yes.
Yeah. So having raised the first check, Rahul, when you look at venture-backed companies, what are some of the common problem areas that you see founders, and not just founders, right? Early teams that come together actually to build startups grapple with? And to your mind, what are some of these that you think are easier to solve for if, founders made note of precedent in that sense, or playbooks that existed out there? What would some of those areas be?
I think the panelists after me will be better suited to answer that, but
They will. They will.
from my perspective, there's the classic founder's dilemma, right? Which is a founder who gives up more equity to attract investors builds a more valuable company than one who parts with less and ends up, with a less kind of valuable slice. So I think that you kind of think of that mindset as that's always the founder's dilemma. Do I go raise money, etc.? But after you kind of raise that to your question, I think pre-revenue companies got to be the co-founder. If I'm a tech guy, then I got to go find somebody from a perspective to go. I think by stage, those are kind of different issues they fall. In the post-revenue, let's say in the 1 to 5 million ARR, I think a lot of them are utilized, really can't scale up. And that's where I think the co-founders and the team have to go build. And then you're grappling with this whole capital inefficiency. What I could do for a 2 million sales, now if I'm going to the $10 million sale, I need 5 times more the people or 10 times more the people because there's capital inefficiency happening from a support perspective. So I think, that's from a founder perspective who's been very close to everything and hands in every little thing. And now suddenly trying to take a bit of a step back and let people run that. I think that becomes can be tough, right? And you think of the mindset that this is, the classic is, this is my baby, I'm going to run with it. And now suddenly you're going to have 10 other people telling them what to do. That becomes critical. And then I think more tactically, building that first, after you built the CTO and the founders or co-founders, the second run is the most critical aspect that you kind of start thinking about where to invest your time and money in.
Got it. Anything anecdotally that you want to share with us, Rahul, in terms of how you've seen perhaps better use of systems and processes kind of alleviate some of these problems that early teams might face, first-time founders especially, who haven't seen a curve of this already?
I mean, from a system perspective, yes, I think that's, you know, everything is manual when you're in that early stage, right?
Yeah.
So, you know, when do you make that transition from, hey, I have everything in an Excel spreadsheet to something a bit more robust? And, you know, this can be a bit scary to a founder to say, hey, now, you know, I'm not going to, I mean, it can be an ERP play, it can be a Salesforce play, can be whatever else, right? So that becomes, you know, taking that leap gets, but, you know, I have worked with, I mean, late last, about a year ago, you know, I was working with one of the founders and they were pre-revenue and they were doing some contract manufacturing. They were putting software on the system that they were, the product they were building. But the contract manufacturing was happening in China, and the market was obviously US and Europe. And I think they had 800K of bookings. They were thinking of raising the Series A, but he said, Rahul, you know, even at the 800K bookings, I have a bit of a problem, which is with this contract manufacturing and software and in the B2C space, you know, I can't do everything so manually. So, you know, we work with them very closely to understand what some of those systems could be for, from tracking the different lots, tracking the different parts that are being from a contract manufacturing perspective. And, you know, that can be, for a founder who's not gone through that piece, can be intimidating, right? And I've heard terminologies like, oh, it's a root canal, it's a heart surgery. I've heard all of those kind of stories,
Right.
and that
Right.
becomes really tough for a founder to kind of think about, right? And that's, I think, for them to take that, you got to build scale. And how do you build scale, right? And it cannot be just done everything manually. So I think that's where, you know, a lot of the blind spots that I've seen with founders as well is, yes, I'm going to continue, you know, manually, and I can throw people at that, but I think at some point they've got to say, that's not my core focus. That will help me get there. Let me focus on the brand and the culture, and the systems should be able to, whether it's real-time data, whether it's looking at where my sales, etc. I think that becomes critical for them.
All right. Are you also seeing, Rahul, that a lot of founders now are more open to adopting software productivity tools and all of that, ERP systems even much earlier rather than later, and just looking at data that you might have access to? What is the typical curve at which systems like this come into play? NetSuite, for instance.
You know, earlier, like I mentioned, you know, there are funds that have gone from, you know, mega funds to you know, growth equity.
Yes.
I mean, the same thing is really happening in even in NetSuite Oracle. I mean, the last 3 years, we've hired, I think, 300 plus account reps and sales reps to focus on companies in the 1 to 5 million. And what we've done, at least from a NetSuite perspective and Oracle perspective, we've created a product where we'll go to a founder and say, hey, you don't have to think about, oh, is it going to be very costly? Is it going to take 6 months to implement? No. We've got 23,000 customers, right? We've talked to so many founders, you know, we got whom we've gone and said, based on your size and shape, this is the system, this is the solution they should be looking at.
Yeah.
And we get them up and running in 30 to 45 days, which is unheard of in the market. So there's a lot of focus in that kind of pre-revenue, 1 to 5 million focus. And we've created the product, the pricing, and the implementation to reflect that. And that's been the biggest growth from a NetSuite perspective for us.